What's up you guys, Sasha here. Now literally just a few hours ago as I'm recording this, the Telegraph published a piece in their newspaper which was an interview with Silvana Tenreyro, who is a member of Bank of England's Monetary Policy Committee. In this interview she said that if the economic recovery following the COVID crisis stalls, if the economy doesn't go back via a sharp V-shaped recovery, then the bank would consider and is considering actively and trying to understand the impact of introducing negative rates for the UK. Now all of this was said in a very hypothetical way, but cases around the country are growing at a very fast rate. Local lockdowns are being placed all over the country every single day it seems, and by the time this video goes out, there is a chance that the whole country will go into another lockdown that the government is saying may last several months. So the V-shaped recovery that people kept saying is going to come is probably quite unlikely. I mean, I did say at the time, I even made a video at the time which said exactly this, but now it is all unraveling and people are somehow surprised by the fact that the economy is not immediately bouncing back after what happened earlier this summer. So if the Bank of England does introduce negative interest rates in the next few weeks, what will this mean for the economy? What will this mean for you? What will this mean for your product? Does that mean that you will have to pay to have savings? Does that mean you'll be able to be paid to take out mortgages? Let me cover this in a bit of detail. Let me tell you exactly some examples of how this has happened in other countries, how this has happened in the past, and what the differences between those examples and the way the situation is going on in the UK at the moment are, and what that might mean for the way the products might change and the types of products that will be available in the market. Now let's quickly talk about the situation as it is right now. Where are we economically? The Bank of England base rate has been at 0.1% since March, a record low. It is a long time to be sitting at this record low. There really couldn't have gone much lower than this. Inflation has recently taken a nosedive. In August it dropped to 0.2% from the 1% it was in July and from the higher numbers it was earlier this year. That's probably not surprising. People are sitting at home, people are cutting down on spend, people's incomes are dropping so they're less able to go and purchase goods, and people are certainly being a lot more cautious with spending money on luxuries. People are much more interested in spending money on food, on their rent and basic bills. So exactly what might happen if these rates drop? Now really quickly, who is the Silvana Tenreyro person who this interview was with? She is one of the 4 non-executive equivalents of the Monetary Policy Committee that the Bank of England runs. It's called an external member, so she's not part of the active committee, she doesn't work for the Bank of England directly, but the committee in total has 9 people who are part of that committee. One of those people is the Bank of England governor, who is currently Andrew Bailey. He is ex-FCA, he replaced Mark Carney earlier this year, and since he has come in, the committee has not once changed the rate. In this interview, Silvana alluded to the fact that the Bank of England is specifically trying to understand what tools are available to it, what are the impacts of using those tools, and when should they go and use those tools if they ever have to. Paraphrasing the interview, using negative interest rates is one of the tools in the arsenal of the Bank of England's Monetary Policy Committee. And given the point I made earlier about the situation in which these rates might be introduced, later on in the very same interview, she said that more lockdowns could slow down the recovery process. So if she's saying that, just after saying that if the recovery process slows down, we may use this tool, you can draw your own conclusions as to the likelihood of negative interest rates actually coming to the UK in the next few months. Now, just a few days before that, Andrew Bailey was actually at the British Chambers of Commerce giving a speech, and in that speech he said, "Bank of England will do everything we can within our remit and powers to support businesses and people." So if they are planning to do everything within their remit and powers, and one of the things within their remit and powers is introducing negative interest rates, and they will introduce negative interest rates if the V-shaped recovery doesn't go back via the V-shape and stalls, and if somebody who is a member of this very policy committee is then saying that their current forecast and their outlook is that the recovery is stalling, this is beginning to paint a relatively solid picture about the likelihood. Now in recent years, a few countries have actually gone and done exactly this. After the 2008 financial crisis, a lot of economies just didn't ever recover fully. They didn't go into full power mode, and in the last few years, several other countries have begun introducing negative interest rates. Most notably, Switzerland did so 5 years ago. 5 years ago, they changed their interest rate to minus 0.75%, and some other countries followed suit, specifically Denmark and Sweden. If you look across the pond, the US has introduced a 0% base rate in March, just when the pandemic was starting out, and they haven't changed it since that point. So exactly what are these base rates and how do they impact the economy and how will they impact you? The central bank of a country or a group of countries in some specific cases is basically the rate that that bank pays other banks or financial institutions who deposit money with the central bank for the pleasure of being able to look after their money. So if the rate is 0.5%, that means for every £100 that some other bank goes and deposits with the central bank, they will then go and pay them 50p per year for the privilege of having that money stored there. Now the central bank is able to go and change that rate to try to affect the way the economy is shaping in the country. If they go and increase the rate, they're going to encourage and stimulate saving because the rates are going to go up. Therefore, the banks are able to deposit more money and earn more money from the central bank in return. And as a result, they're able to take deposits from customers and pay those customers higher returns as well. So that will encourage people to save money. That will encourage people to go and deposit money into various kinds of savings accounts to earn those high interest rates. If they then go and actually instead reduce the base rate, then what will happen is they are discouraging people from saving, and the more they reduce the rate, the more they're telling people that they need to go and spend because saving money actually doesn't yield any returns. They're either encouraging you to go and invest money into businesses, invest money into the stock market, or invest it into higher risk avenues than savings accounts, or they're telling you that you should go and borrow money because borrowing money is becoming cheaper. The lower the base rate is set, the lower the lending rates in theory should be if everything else is equal, because the banks don't get much return for their money by depositing it with the central banks. They might as well lend it out to people and businesses to get better returns there instead. There are other impacts as well. It is quite a complicated topic. There's impact on the currency valuation and the ability to trade imports and exports, and lots of other implications of changing the base rate. But we're just going to talk about the consumer aspect of this, the impact that they directly feel in this particular video. So if the interest rates actually turn negative, what does that mean? Does that mean mortgages begin paying you? Does that mean that your savings begin actually costing you money instead of paying you money? Now first let's talk about the savings. And on the savings front, the answer is no. You probably will not have to pay fees on savings, and certainly the examples that we've seen from other countries around the world, including Japan and including countries I mentioned in Europe, has shown that that doesn't happen. And there's one really big reason. The moment you go and introduce fees for people being able to keep savings in banks, you're going to instigate a massive bank run. Everyone who has any form of deposits in their current accounts and their savings account, if they have to pay money to keep the money in that bank, they'll go and withdraw it. And what you're going to get is all the banks are going to have a massive liquidity issue because people are going to be withdrawing all the money so that they don't have to pay those fees. People are then going to have lots of cash on their hands, and there's going to be massive questions about what exactly are they going to do with that cash, where are they going to put it after they've withdrawn it from all the banks. There's a lot of unwanted economic consequences of doing that. But usually what does happen is for accounts that have very large amounts of money, a negative interest rate is introduced. So if you look at the example of Switzerland, in cases where people have hundreds of thousands of pounds worth of money in their savings account with these banks, there is a negative charge on those accounts. And typically that is not very high, but it can go as high as minus 0.6%. So if you have a lot of money and you don't want to invest it in the stock market or anything else like that, and you want to just go and deposit it in a bank, you will essentially have to pay money every single year for your money to be able to sit in that savings account. That is a real practice in Switzerland. That is a practice that is likely to happen in the UK as well if the interest rates turn negative. Turning to lending, I just wanted to clear something up to make sure that people aren't disappointed. If you have loans, if you have credit cards, or if you're going to get new loans and new credit cards, the likelihood is your rate will really not change at all. In fact, the cost of funds on those types of products is a relatively small component in many cases of the overall P&L, and as a result, it doesn't really have a huge impact on the pricing. Things like risk, things like your ability to repay the loan, things like costs of actually operating the loan, so having the call center, having the various operational facilities to be able to issue the money to you, make the assessments about whether or not you're eligible, all of that stuff is costing money to those lending businesses. So you probably won't notice any real difference if the interest rates change on those types of products. but you will on mortgages. In Denmark, one of the countries that has dabbled in having negative interest rates in recent times, you can get a mortgage for 10 years with a negative, yes, minus 0.5% interest rate. That is with Jyske Bank, the third biggest bank in the country, is offering those types of deals to their customers. And this is amazing. What this means is when you pay for your mortgage, the mortgage actually goes down by an amount that is greater than the payments you've made every single month. So you don't actually get the cash paid to you, but it is pretty amazing. You're essentially being paid to have a mortgage, because in the case where your personal risk is low, and if your loan to value ratio is low enough so that the bank literally carries no real risk in terms of that house not being worth the amount of money that the mortgage currently has on its balance, essentially that mortgage will pay you less than the amount of money that they will have to pay to the central bank to deposit their money there instead, and therefore it is a commercially positive decision for the bank. So will you be able to do this in the UK? Will this scenario play out in the UK? Now, I'm not a financial advisor and don't know your personal circumstances, so you need to go make your own decisions, but in my personal opinion, the answer is a big fat no. Yes, rates probably can, and there is a good chance that they will go negative. But there's a big difference between the scenario that's playing out now and the scenario that we were looking at in the last few years in those European countries. And the difference is the risk factor is changing very rapidly. The main bulk of the furlough scheme is running out in just a month's time. And after that, there's some other job retention programs that the Chancellor has just announced in the last few days, but that program is just nowhere near as robust enough. And at the moment, there are literally millions of people in this country who are either in the process of losing their job or in some form of consultation or in a massive state of uncertainty around whether they're going to have a job to go back to in a month or two's time. 90% plus mortgages are already pretty much non-existent because of the high risk of the housing market crashing in the next few months. Now, that hasn't happened yet because the government went and introduced several policies that have artificially propped up the housing market, and there's a bigger brand of hype about it. There's a lot of people buying houses who probably weren't considering buying a house previously. There's a lot of people making use of the fact that you don't have to pay any stamp duty, which was a big factor in buying a house previously for a temporary period of time. But in the long run, the lenders are uncertain whether the house prices are actually going to stay there, and they're certainly anticipating that early in the next year, this situation might change very rapidly. That is why you can't get mortgages which are 90, 95% or 100% off the value of the house. Those people have teams of analysts who are building models and assessing the situation, and they're telling you that they think the housing market is going to crash. So maybe the people buying houses right now know better than those analysts, but that's their decision to make. Anyway, even the mortgages that are available today, the rates on them are still above 1%, even for very, very low loan to value ratios. So if the base rate goes and changes from 0.1 to something negative, as long as that's not going to be -1 or lower, which I haven't seen in any other European country recently and is an unprecedented jump and probably won't happen anytime soon. So in that situation, it is unlikely that the mortgage rates, when you consider the risk factor, will actually reduce by the same amount or even get close to the zero mark, because there are two massive risks that are much, much greater in the situation right now than they were just a year ago. One is the housing market crash that I was talking about. Whether that's going to happen, how much the housing market will actually crash and the impact on valuations of houses is a question that nobody has an answer to, but there is certainly a likelihood. And the other part, which is the risk of people not being able to actually meet their repayments. So just because you have the property as an asset which is there in case that people don't pay their mortgage doesn't mean that the bank carries no risk. There's a massive cost associated with appropriating the property in the case of people not being able to meet their payments. There's a massive time lag between when people stop paying and when the bank is able to repossess the property. There's the costs associated with the process and all the legal fees and the selling fees and everything else like that. So the bank still doesn't like those situations, and it's not 100% of the money that they recoup in those circumstances. So if people begin losing their jobs by the million, which is literally ongoing right now, there are tens of thousands of jobs being lost every single day. Just go and open a newspaper and you will see it in there. If those people, after losing their jobs, are unable to go and secure a new job because there are literally no jobs in the market, and they're then unable to meet their mortgage repayments, then that risk is another very high risk to the lenders that they just simply don't want to take on. So what this means is, even if the base rate is negative, the fact that these two risks exist today and they're significantly higher than they were a year or 2 years ago probably means that you're not going to see negative mortgage rates in this country, even if the base rate went below zero. It is possible, and there might be a small chance, that one of the challenger banks or one of the newer banks uses it as a marketing ploy for very low loan to value ratios of say 0.4 or something like that, where they'll offer a negative rate or a zero rate just to get free press, just to get free marketing and free PR. But I don't think that's going to be a mass market strategy, and I don't think it's going to be available to a very large number of people. If you have a different opinion, please make sure you go and leave a comment below. I'd be super interested to find out what you have to say. If you have some interesting thoughts on the subject matter, or if you have any questions, go and leave a comment as well. If you're interested in this type of video, if you're interested in hearing more about financial services products, about the economy, and about managing your money through uncertain times, make sure you go and subscribe to this channel. That is what I talk about 3 times a week on a Monday, Wednesday, and Friday. Make sure you smash that bell next to the subscribe button for the notifications. Even if you subscribe, you might not actually see my videos, because that's how YouTube works these days. Go and hit that bell, then you will get notifications every single time one of my videos comes out, and you'll be able to go and watch them without missing anything. If you enjoyed this video, please go and tell YouTube that you like this video by hitting that blue thumbs up button. It is so critically important for the YouTube algorithm. That is how YouTube knows to show this video to more people. Thank you so much for watching, and I'll see you guys later.
Can we work it out? Only time will tell. It's gonna take a lot.